Have you ever been about to buy a stock and wondered if you've thought of everything? Could you be missing something? Today I'm going to share the 3 most important questions you need to think about before you buy any individual stock. Now, I've seen these lists before and they're usually pretty useless. I Googled the best questions to ask before you buy a stock, and the very first result had a first question of, what does the company do? Now, if you're thinking about buying a stock and you're still asking yourself, what does this company do? Just stop. Don't do it. Don't buy the stock. All the other questions are really broad in general. Things like, what's the PE ratio, other financial metrics? What are their profit margins? Do they have a moat or differentiation? What's their management and their future plans? These sound great in theory, but once you understand how markets actually work and how stocks are priced, these questions become pretty irrelevant. The first question you should really ask is one of my favorites anytime I'm talking to somebody about buying an individual stock. If you've reached the point where you feel ready to make this investment, I think this first question is almost a reality check to really understand, is this the best idea? Because trading is all online and digital now, people forget that buying a stock is a round trip. For every buyer, there is a seller. So you need to ask yourself, who is on the other side of this trade? If I am buying this stock, who is selling it to me? The odds are it's not your neighbor or your pickleball partner. About 90% of stock transactions are done from institutions. Those are pension funds, endowments, hedge funds, and Wall Street firms. And the reality is they have a team of analysts, they're working around the clock, and they have an unlimited research budget. They dedicate their entire existence to making money from the stock market. I think it's safe to say if you are buying this individual stock, it's because you think it will outperform the market. If so, it's safe to reason that this institution is selling this individual stock because they believe it will underperform the market. Only one of you can be right. Which brings us to question 2. Think back to what made you want to buy this stock in the first place. Maybe you read about it, maybe you saw Jim Cramer talk about it or on CNBC. Maybe it's a company you use the product of and you just love the product. Or sometimes it's just a company in the same industry that you work in and you feel really comfortable and familiar with the technology and the future of that sector. Maybe it's just gone up a lot recently and you think that trend will continue. To truly understand question 2 and its importance, you must know how markets price stocks. While not perfectly efficient, it's pretty efficient at pricing assets, and it's best that you treat it as such. Being efficient simply means that all available information is priced into the stock. There are tens of billions of dollars worth of stock trades on the market each day. That creates an effect of aggregating every investor, institution, and AI algorithm's belief into what a fair price for that stock is today, given all of its current known information, as well as all future expectations. Everybody is inputting their belief into that stock price, some positive and some negative. What you end up with is an aggregation of every investor's belief of what that stock price is worth today, given its future expectations, and what each investor is willing to pay today for the expected future cash flows. Take electric vehicles. You might think that EV is the future of the auto industry and the energy sector in general.
Hello, I'm an electric car.
That's great. The problem is, so do a lot of other people, and because of that, the price of stocks in the EV sector are very expensive compared to their current profits and cash flows. People are already expecting a revolutionary future from this sector, and they're paying a premium for that. The future potential is already priced in. So for question 2, you need to ask yourself, what do I know that nobody else knows? And remember who your competition is when you are buying this stock. When you are buying this stock and thinking, I might know something nobody else knows, your competition are Wall Street firms and institutions who, again, have people dedicated to just studying this one company or this one sector and trying to extract as much money out of the market as they can. Do you really feel you have more information than they do? Do you really feel you have more information than all the investors in aggregate globally? And if so, are you able to interpret this information better or more efficiently to truly predict a stock price different than what the market in general has come up with? Question 3 is based on one of my favorite stats in the stock market. A research paper came out in 2019 by Hendrik Bessembinder, and these stats have been living rent-free in my head ever since. He analyzed every stock since 1926 that's been in the CRSP database. CRSP is the Center for Research and Security Prices. So again, they looked at over 26,000 stocks since 1926. They showed that only 4% of stocks account for 100% of the market gains above T-bills. So essentially 96% of stocks did not outperform simple government bonds that are short-term, what we call in the investment industry the risk-free asset. I can loan my money short-term under a year to the US government, they'll pay me interest and give me my money back. So 96% of stocks did not outperform those simple, almost risk-free treasury bills. Over half of the stocks actually reduced your wealth if you invested in them. Even more alarming is that just 0.3% of stocks, so just over 80 companies, account for half of the gains. Now this can be tricky to understand, but it's because markets are positively skewed. While most companies go nowhere and often just lose money, there are a few companies that have incredible gains. And those gains from the few companies far outweigh the negative results of the majority of companies. Think about it this way. The worst a company can do when it goes public is lose 100%. However, there are companies that gain thousands of percent. Think of like an Apple having gained over 170,000%. We've also seen something like this today with the Magnificent Seven. These handful of companies have had outsized gains and have been propping up the entire market, whereas the rest of the stock market has generally underperformed, meaning most of these companies in the S&P 500 have underperformed the S&P 500 index. So once again, we have a small handful of companies that are propelling the entire market forward and the ones that are generating real wealth creation. So if you positively answered the first two questions and you're ready to buy this stock, ask yourself one last question. Am I picking the 4%? As the data shows, if you aren't picking the 4%, you're better off just buying a T-bill. It's obviously impossible to know which stocks are going to be the 4%. And the even harder part is, the majority of the time, it's not the ones that have been performing the best recently, and it's also generally not the largest and biggest, best-known companies that go on to become the 4%. It's obviously impossible to know what the 4% are going to be, or the 0.3% even better, and historically, it's been an underperforming strategy just to try to cherry pick the most recent best performers or the best known companies. So stock pickers are in a tricky position. If you love buying individual stocks, you enjoy the process and the research and having some skin in the game of investing in individual stocks, go for it. It's best to just pick that position size appropriately, what makes sense based off of your overall investments and your net worth. How much do you want to put at risk here? Because there's no denying the data is very clear. With the majority of your wealth, you're best to tilt the odds in your favor. You do that by owning simple index funds. That's the only way to ensure you are going to own the 0.3% and the 4% moving forward. If you enjoyed this video and found it beneficial, please hit the subscribe button below and you can get notified of our weekly videos. Thanks for watching.